Okay, welcome guys. So this is DC. So this is part of our mentorship program. So what I'm currently doing is this. I want you guys to have a taste of our mentorship program. Yesterday we had a very good lesson. We were talking about demand and supply zones. So today's lesson will be focusing on order block, smart money trading. What is smart money concept? What is smart money concept? What are smart money? What are order blocks? How do we trade using order blocks? How do we identify an order block? And many more other things that will be there. So from today, by the end of this lesson, you should be able to use an order block, be it a bullish or a bearish order block. So the focus on today is mainly on the standard order block. So basically that's what we will be talking about. So this is just an introduction to our smart money concept, which is a lot of topics that are there. Okay, so what I'm gonna do now, I'm gonna share my screen so that you can see what is there on my screen. So I've shared the screen and I hope you can see what is there on my screen. Okay, so this group that we currently have the lessons are going to end very soon, and on the 14th of December, that's when we are going to enroll new students. And if you're interested, you can register and we can start the lessons on the 14th of December. So today we'll be talking about smart money concept. Okay, so this information is information that you can Google. You can go on Google and you can easily get. So let's just go through the standard definitions, and so that you get a feeling of, or you understand what we will be talking about. So we'll be talking about smart money concept. So smart money refers to funds or investment made by knowledgeable and experienced investors or institutions. So when we talk about smart money concept, so in forex markets or in different markets, we have different players. We have large institutional traders. These are the market makers, to say. They cause big movements in the financial markets. So we also have us as retail traders. These are small traders. We don't cause any significant impact on the market. So we have these large, knowledgeable, experienced investors or large institutions. So those are what we call smart money concept. It's a term used to describe the capital placed by individuals or entities with deep understanding of the market. Apart from deep understanding of the market, these guys, they also have large financial muscles that can cause the market to move up and down. Trends and potential risks. Smart money investors typically possesses expert and insights that help them to make well-informed decisions, often seeking high returns while managing risk effectively. They might use advanced analytics, research, or inside knowledge, or to identify opportunities and make strategic investment choices. As a smart money trader, you want to follow the footprints of these large institutions. So when you now decided that you want to be a smart money trader, what you'll be basically doing is this. We don't know when these guys are going to enter the market. What we can see are the footprints that these guys have left behind. So as a smart money trader, you want to follow those footprints. You want to trade with these large institutional traders. These large institutional traders, they come in the form of central banks, hedge funds, investment institutions. Those are the big guys that when they enter the market, they have this expert, they have this experience, they have this knowledge, they also have these large financial muscles, they have large capitals. So one of these institutional reference points that we can use as smart money traders are order blocks. So today we'll be talking about order blocks. So an order block is a concept commonly used in trading and refers to specific price area on the chart where significant buying or selling activities has occurred. So as a smart money trader, you can use now order blocks to identify where smart money traders have entered. How do you see this? You observe on your chart where we have significant buying or selling activities. So that's why this theory of order blocks is more effective or more relevant. They are trying to identify where on the chart there's been significant buying or selling activities that has occurred. It's marked by class of orders that create a strong level of support and resistance. Okay, we'll also talk about why is it price will normally come back to that area where there's been a significant buying or selling activities. In some definition, they talk about when we talk about price action in smart money concept in ICT, the difference is this. I used to think that there's a large difference between ICT and price action concept. If you look at price action, we have demand and supply zones. So with smart money traders, they have a specific entry. With price action, they generalize that demand zone. But on that demand zone, yesterday we were talking about demand zone. So this is more relevant. If you attended yesterday's lesson, it becomes more relevant what I'm trying to say now. So the demand zone, on that specific demand zone, with a smart money trader is able to pinpoint exactly where price is going to reverse. Okay, so we talked about an order block. In an uptrend, an order block represents consolidation. In an uptrend, an order block might represent consolidation or a pullback where significant buying took place before the price continued upwards, its upward movement. So basically, when we talk about the downtrend, it's basically the opposite. It could denote a consolidation or a retracement where significant selling occurred before the price resumes its down trend. Okay, so these things you can easily Google and find them. But what I'm going to teach you now is something that is unique and something probably that you've never heard before. So in my lessons, I want to be more practical. So we're going to go to the chart where I will show you so that it becomes easy for you to understand. So we're going to start order block. The bearish order block, and in June, and with gold, it was 30 October, we had a bearish order block there. So our focus is on this particular area. Okay, so price on this particular level, we can see what we can see is this. When we are identifying on order block on a chart, when we are identifying an order block on the chart, what you want to see is this. There must be a displacement from that particular area. What do I mean? You must see that there was a big shift or a big movement from that particular area, which signifies that there was the involvement of large institutional traders. For example, this big movement can only be done because of what? Because of large institutional traders. So that's the first thing. So before this big movement, before all these red candles, if I go to the daily, okay, before all these red candles, this signifies that there was the involvement of large institutional traders, which signifies that this is where these big guys entered this market, and they've caused the price to start moving downwards. So that's one thing that you see. So you mark the last bullish candle, or here on my chart I'm using red and green candles. So the green candles are representing the bullish candles, and the red candles are representing the bearish candles. So the last bullish candle before the price starts to move downwards is our order block. So what you're gonna do is this: you mark, and when you're marking the order block, you only focus on the body. So the candle is a wick, and this there is also a body. So the candle is made up of 4 parts. We have the high, the low, the open and the close. So you only focus on the open and the close of the candle, or basically the body of the candle. So here, that's what I'm gonna do. I'll focus on the body of the candle and I'll mark it. Why am I marking this area? I can see that at this particular level, there is a possibility that these big institutional traders have entered the market. And for you to know that, according to ICT, he said that these candles or this displacement that took place, we must have at least 2 to 3 candles times the size of that particular candle that you've marked. And we can see this candle also represent that. So there's a big movement from that particular candle. So that's the first thing that you do. Then you're gonna wait. So what these large institutional traders will do is this. They have large capital. They have large capitals. Probably they've let's just say 1 trillion. And not all of their orders were executed when the price started to move downwards. So we said this red candle, this big movement, was as a result of large institutional traders. But these guys, they were only able to place or to only use half of their capital, and they caused the market to move downwards like this one. So these guys are smart. Their concept is this: they want to buy at high price, and they want to buy at low price, and they want to sell at high price. So here they were able to only fulfill half of their obligation, assuming that there was 1 trillion. So that means 500 million. Is it 500 million? Half of, yes. Okay, let's just use 1 million. Half of 1 trillion is what? Okay, let's just use 1 million. These guys, they were only able to fulfill, they wanted to place 1 million US dollars at this particular level. They were only able to fulfill half of that. That is 500,000. And then not all of their orders were fulfilled as the price was coming down. So they will manipulate again the price to move upwards, tricking most retail traders, because they will see that the price is now bearish, the price is coming down. So most retail traders who have the problem of FOMO, fear of being left out, they will just quickly jump into the trade, assuming that the price is now moving downwards. And then they will manipulate the price again to come back to this particular area. Why? Because not all of their orders were fulfilled. So this is the reason why in most cases price has to come back to the order block. Why? Because we have unfulfilled orders that were not executed. So they want to fill few hundred orders, and only half of that was filled. So they will manipulate the price to go down and come back here, and then they sell at high prices. So when the price is moving downwards, so what you normally see is that retail traders will place their stop losses just around this area. So let's see what then took place at this particular level. We have the price coming down, and price is still moving downwards. And price is moving downwards. We still have price moving downwards. And what do we see at this particular level? So go charting, when it comes to drawing, the drawing is a little bit difficult, but it has this nice replay mode which I enjoy using. Okay, so you see price is coming back again to that order block. So when marking an order block, okay, let's just do the proper thing. So when marking an order block, you have to mark this particular level. The open of this candle, this particular area, that's what you mark. And what validates this order block is the fact that we have this red candle that is closing below this previous low. So this one validates, this candle validates this order block, and we have a big movement, a big shift as the price was moving down. And if you look closely, we also have a change of what character. The price was bullish, and now the price is was able to close below this particular level. So if you move down to a lower chart, you'll see that the price was able to trade below this particular level, signifying that there was a change of character. So we'll talk about what validates an order block so that we are able to distinguish from. So if you mark this particular area, the open of this candle, or where this body of the candle is, the lower part, since you are looking at a bullish order block, you mark it and then you wait for price to return to that particular level. So here, when price return to this particular level, you want to execute your trade at this particular level. So we're now talking about execution. So there are different ways that you can use to execute or to take trades when you're using an order block. So this one is the common method, but we also have the one where you are waiting for a change of character or a shift in market structure, then you execute your trades in the lower time frame. But this one is another way that you can enter trade using order block. So you wait for price to come back to that particular area where there was a big displacement, and then you highlight the body. You only focus on the body, you ignore the wicks. I will show you where the wicks will play. And what we can see is this: the price came back to this order block, and when it came back to that order block, if you check here, you need to also measure. So I'm gonna teach you also something about order blocks and how you can use it in ICT. So we have the 50%. The 50% of this is what we call the mean threshold. So in most cases, when you're using order blocks, especially in Forex and other assets, that's where these order blocks are more relevant. They say that in order block, for example, when the price returns to the order block, like what happened to this particular area, it mustn't close above the 50% of the mean, they call it the mean threshold, which is the 50% of the Fibonacci. So this is my Fibonacci, and I have the 50% level here. So you mark the candle here, the body of the candle here, and you want the price to close below the 50% of this order block. This validates, or this will signify that there is a high likelihood that price is likely going to respect that order block. And we can see the mean threshold, price didn't close below this mean threshold. And again, where are you going to place your stop loss? You need to place your stop loss just above this level. And you can see if you place it close, very tight here, you're going to be taken out, and yet the price was going to move away from that order block, and this was going to be a valid order block because we don't have a candle closing above the 50%, which is the mean threshold. But when it comes to gold synthetic indices, you see that sometimes the price will just come closer. It will close below the order block, and it will even go above the 50% or the mean threshold, but it will then reverse and move upwards. So this concept of using the mean threshold for you to know if price is going to respect the order block or not works mostly in Forex. When it comes to gold, when it comes to cryptocurrency, that concept is not that applicable. So according to ICT, and when you're using order blocks and you're trading currencies, you must respect the 50% the mean threshold of the order block, which is this line. So that means if your stop loss was here and the price closes above the mean threshold, it means that you need to cancel that trade. But you'd see that with gold and synthetic indices, that doesn't normally take place. So your entry is here on the candle open of this green candle, and then you wait, you place your stop loss just above the you can place it above the previous swing high, which was this one, and then you wait for price to return, and you're going to enter the market when price came back to this particular area. And we can see the price from that particular level was started to move away from the order block. So your targets will be the recent swing low, which was this particular area. So you can focus on this level. You can focus on this area, which was the recent swing low. Why focusing on this area? We'll talk about something else at this level. Okay. So as we play, we can see our take profit was hit. It was a very successful trade. So we've talked about how we can identify an order block and what validates an order block. And okay, there are two things that I didn't mention, which is the fair value gap and also the fact that an order block, for it to be valid, it has to carry two common characteristics, which are the following. One, we have what we call a fair value gap. We have what we call a fair value gap. What is this animal? A fair value gap. Okay, so what I'm gonna do is this. Let me cancel here and put my replay on this particular level. So we're gonna focus on the last three candles. 1, 2, 3. We're now talking about the fair value gap because it's one of the characteristics that is required for an order block to be valid. So if you look at these three candles that you see at this particular level, the first one will be the one on top. So this one is our first candle. You are now going to focus on the wick of that candle. You are now focusing on the wick of that particular candle. So this bearish candle, this is our first candle, second candle, and third candle. The first candle, this one, the low of that candle, which is this one, in a healthy price action, it should be connected to the high of the third candle. This is the third candle, and we can see from that particular level that the high of that particular level here, this is the high. We are still on order block, but we want to learn about fair value gaps so that we know what validates in order block and what doesn't validate in order block. So if you see in 1, 2, 3 candlestick price action that we have at this particular level, the low of this first candle must be connected to the high of this third candle, and we can see we have a big gap. This gap is what we refer to as a fair value gap. And we have different types of fair value gaps. Fair value gap. So we have different types of fair value gap. They can there are a lot implied. We have a lot of fair value gap. Inversion fair value gap. There are a lot, but now we're just talking about a standard fair value gap. So in this case, we call it CB, sell side imbalance, buy side inefficiency. So it's called a bearish fair value gap or a CB, but just know that this one is a fair value gap. Forget about those names. Okay, so this gap is what we call a fair value gap. So in a healthy price action, if you try to look at, let's look for another example where there was a healthy price action. So regardless of the color of the candle, ignore the color of the candle. They can be green, they can be white. But in a healthy price action, these three candles must price, if the price is balanced, they must be connected together. Okay, let's just look for an example where we had a balanced price action. Okay, which one should we look at that is very close? I want to look for a balanced price action. Okay, 1, 2, 3. Yes. Okay, let's use this one. Okay, if we observe, we have 1, 2, 3 candles. They are all red. And I said, when we are looking at fair value gaps, forget about the color of the candles. It doesn't matter. So we are now on 57. That means we are now left with 3 minutes. We can rejoin after the meeting has stopped. I will send you a link. So if you observe those 3 last candles, this 1, 2, 3, the low of the first candle and the high of the last candle, they are almost connected together here. So this is 1, 2, 3. This one, the high of this candle is connected to the low of this candle. So we can see at this particular level, we don't have a fair value gap. So in most cases, when price is balanced, from what we said last time, I think we talked about the fact that the price is always moving to do 2 things. One, to grab liquidity, and to also fix an imbalance. If there's an imbalance, so a fair value gap represents what we call an imbalance. So if there's an imbalance, you see that price in most cases will always return to fix that imbalance, and that's basically the concept. So when we are talking about order blocks, that fair value gap concept also works. So near a fair value gap, you must have a situation where there is a fair value gap. Near an order block, there must be a fair value gap close by. So near the order block, there must be a fair value gap that is close by. So if you look at this particular example, we had this small fair value gap, it was covered. We had a small fair value gap. Okay, I hope you'll be able to see it because it's very, very small. Okay, let me just try to do this. If you look at the low of this candle, the first bearish candle, this one, and the high of the third candle are not connected together. So on that particular order block, we also had a fair value gap. So this fair value gap was valid. Why? Because there was an imbalance. Price had to come back and fill this imbalance. Price is always coming back to this. You can use this as a trading trading strategy where you're identifying fair value gaps and you're using them for your entry. You'll see that you'll be able to make a lot of money, especially if you go on the high time frame. Price will always come back to fill those gaps because it's an imbalance. Price will always come back to fill up that imbalance. So this one is what we call a fair value gap, and the fair value gap is closer to the what? To the order block. So if we come back and mark out our order block, so when marking we said, although people now use, some people might be wondering, why is it I'm only marking the body and I'm not marking the whole candle? People have now been used to that, but when marking an order block, you can just do this. Why are you marking this? Because you want to see, one, if when price come back to this particular level, that's where you're going to what? To execute your sell order, or you can place a sell limit. So you can place at least 2 pips below the particular level. That's where you place your stop loss at just 2 pips. So if it's on 1938, so 2 pips, that's where you can what? Place your sell order 720. So that means 720, 2 pips below. I think you get what I'm trying to say. Then as we can see, price came back because of the fair value gap that was there, and this displacement that took place here. And also when price was moving up, I think I told you that if you go to a lower time frame, you'll be able to see that there was a change of character. What I'm trying to say is this: at this particular level here, okay, even here we can see price came down. Okay, assuming that this is the previous high low that we had on our chart here, we can see that price was able to trade below this particular level, this particular low. Okay, we also have this level, this retracement that took place here. So our high low was here, and when price trade below this particular level, we can see that there was a change of character. So there are 2 things that are there on this order block. One, we have a fair value gap, which is here. So we're now talking about what validates, because the problem with learning about order blocks is that whenever you see a bullish candle, when the market is moving down, you think that that one is an order block. So how do you know if this is a valid order block? One, you look, is there a fair value gap? Yes. Is there a change of character or a break of structure? It can be a change of character, so this is what we call a change of character, or it can be a break of structure. So those 2 things, if you use them in most cases to validate if that particular level we have a valid order block. Okay, so this is an order block that we have. There's a fair value gap, a change of character. Those 2 things validates in a valid order block. And we can see when price came back, one, price didn't close above this order block. If you are using a particular level as an order block and you see price closing above that order block, there is a high chance that you are wrong. So you before price hits your stop loss, you can easily close that trade. We also have what we call partial losses. So you take that partial loss rather than waiting for price to move up and hit your stop loss. And from that particular level, we see price dropping downwards. It dropped even further. We see price dropping even further, coming downwards. So we can see, so this is how you trade and how you identify an order block. So unfortunately, the meeting is gonna end anytime soon. Don't worry. Don't worry. I'll send you another link so that we can continue and finish. So this is the first example. Let's look at the next example of how we can identify a bearish order block. So this one, let me quickly go to this one. So we have 31 October in gold. 31 October. Then we also have in September, we had something else in September. So this is how easy it is to trade using order blocks. This is how easy it is to identify order blocks from your chart. But what I'm trying to say is this. Someone will say here, so sometimes you would end up seeing order blocks that are piling up here. And we also have a concept like this. So apart from, before I go to the next example, you need to measure your using your Fibonacci. So we have what we call the PD array. The PD array. Smart money concept use this concept. You want to buy when price is above the 50% level of the Fibonacci level. This is where you want to buy. Below the 50%. And below the 50% of the Fibonacci is what we call the discount. So this level is what we call the discount. And this is where you want to buy. And above the 50%, we have what we call the premium. So the premium, so the P stands for premium, the D stands for discount. So you want to sell when price is in the what? In the premium. And you want to buy when price is below the 50%, which is the discount. Sell when price is above the 50. So you also use your Fibonacci again. You use your Fibonacci and you stretch it from the top of the structure here. Our structure was started from this particular level and to the bottom, to the low of that movement. And when we had a retracement, the retracement must take place for you to identify a valid order block, because we also have this last green candle. Why is this one not a valid order block? We can't sell at this particular level. Why? Because price is below the what? The 50% level of the Fibonacci. So that means price is within the discount. So this is the discount. We ignore all the order blocks that are there. But sometimes you end up seeing that there might be two order blocks that are there in the what? In the premium. So what do you do when you are faced with such a situation? One, you look at those two order blocks and you identify if they have a fair value gap. So go for the one that is at this extreme, meaning that if there is one here, it has a fair value gap, and there is another one that is a fair value gap. You go for the one that is extreme, that is on top here, if you're going to be selling. So if the one on top doesn't have a fair value gap and this one has a fair value gap, you focus on the one that has a fair value gap. But this has to take place within the premium territory. So we're now talking about, we talked about three things. One, if you want to validate an order block, a bearish order block, so this one is called a bearish order block. This one, you wait for price to come back to the 50 premium level. So it has to be one above the 50%, which is the premium level. Then there must be a break of structure and it must have a fair value gap. If you can have all those three, and the displacement, the movement that took place when the price was moving away from the order block, it must be massive. It must be massive. And I said we must have at least 2 to 3 times the size of the order block that you have marked. So you must have candles that, it can be a combination of candle, it can be one candle, it differs, but it must be 2 to 3 times the size of that candle that you've marked. So if you can pick all these 4 things, it can validate an order block. So what I'm teaching is the things that I do. It's not something that I've learned or what. It's something that is more practical. Okay, so let's quickly look for another opportunity where we're going to use our order blocks. I think there was an example in October. Okay, yeah, this one. Okay, this particular level. Okay, what we can see is this. We have priced this particular level using this level as a support. So sometimes it differs. When you're looking at an order block, it must be at a level where there is a what? A support or a resistance. In this particular level, we are looking at an order block within where we want to sell. So it has to be closer to a resistance level. So that's one. And what do we see? When we had this candle, the last bullish candle, as the price started to move downwards, we had this candle. So we mark that candle. The last candle. So you mark the body here. That's what you're gonna mark like this. And we can see it also falls under the category that we have talked about, the displacement. We can see it is actually 2 to 3 times bigger than the size of the what of this bullish candle. We have big candles, which are signifying that there is the presence of large institutional traders. They have stepped in, and when this is taking place, you can see this will normally lead to fair value gaps. When price quickly move away from that particular level, what do we have? We also have a fair value gap. So let me not use lines. For the fair value gap, we have this low and the third candle is a high, which is this one. And we can see when price was moving away from that particular level, it left an imbalance. There was an imbalance that was left at this particular level. So we also have a fair value gap. Okay, so let's wait and see what then happened here. We've marked our order block, bearish order block. So this is a bearish order block. The last bullish candle before these red candles is what we call a bearish order block. And we can see price came back. Price came back to this particular level. Here at this particular level. So you're going to be triggered in at this level. You're going to be triggered in. So there are different levels which you can use for your execution when you're taking trades. When you're taking trades using order blocks. Then what we can see here is this. When price came back, we can see, and we talked about the reason why price would want to come back, and we can see at this level we had this low. If you move down to a lower time frame, we can see price also took out that particular low. Price also took out that particular low, which was this low. That's one thing that we can see. So there was a change of character. And these big movements can be a result of what? So if you move to a lower time frame, you would see that there will be a change of character here. Price was able to close below this low. But apart from that, if you have a bullish candle and the size of the bearish candles that followed after that bullish candle are at least 2 to 3 times the size of this one, you mark that level because it marks out an order block, especially if you're on higher time frames. For example, the H4, the daily or the weekly time frame, that can be your order block. And we can see after this replacement, displacement, price returned back to the what? To the order block. And we can see from that level, price started to move away. So if you use this, especially in volatility indices, this works perfectly. Although in boom and crash, the effectiveness is a little bit reduced. But in volatility indices, I'm telling you, you'll be able to make money. I was afraid to trade volatility indices when I started. They were one of my first assets that I started trading, volatility 75. And I lost a lot of money because I didn't understand how price was moving. Because I also had that mentality that if I see a series of red candles, I will sell. Then the moment that I sell, I start seeing the price moving up. Then when I buy at this particular level, because I'm now seeing green candles, the price is starting to move down. I didn't have this understanding of order blocks, how price moves, and how institutional traders influence the movement that takes place on the chart. Okay, so from that particular level, we can see price was able to retrace and was rejected. We can see there's a very big rejection that took place on this 4-hour candle, and we can see price started to move downwards. So we're only talking about the first execution, but there are about 3 or 4 ways that we can use when we're trading order blocks. And in today's lesson, I'm just trying to simplifying it here. So we want to sell when price has reached this particular level, and we can see when price go to this level, it started to move downwards. There's a big rejection, and from there, our target in this particular case was going to be the recent swing high, and we can see price was able to hit that particular target. So here, this was our target, the previous swing high, and we can see price retraced and hit this particular level. So this is how you trade using order blocks. So we're talking about a bearish standard order block. This one is a bearish standard order block which we use for selling. Okay, let's look at the bullish scenario. So if you can understand this, the opposite is now true. It becomes easy for you to understand how you can trade using a bullish order block. So let's quickly look at